Hi there and welcome to Market Conversations. Just want to do a quick video on Alibaba. So it looks like we had another red day. As expected, there's just no bottom for Chinese stocks right now. I think what we need to do is possibly hedge our position if we're holding a large number of shares on Alibaba. So we take a look at the 6 months daily chart. It was trading above 220 back in June, July, and ever since then, it's been trying to break out above this 181 resistance, couldn't hold. And then we see this huge sell-off, this gap down. This was when they reported their earnings. And ever since then, we can see how many candles? 4 red candles. The RSI is currently indicating oversold, but that doesn't matter anymore. There's a lot of stocks that are oversold, but guess what? They just keep going down. Let's take a quick look at the news. We have a lot of downgrades. So, for example, Needham analyst Vincent Yu maintaining buy rating on Alibaba shares, but reduced the price targets from $330 to $230. This is what he said. Alibaba reported a rare miss plus guide down for its September quarter, with both top and bottom line trailing expectations and revenue growth guidance lower from 20% to 23% from 29.7% growth announced in May. Growth at core commerce and customer management revenue slowed on weak macro and intensified competition, the analyst said. Margins, meanwhile, were hurt by spending on merchant support and the permanent waiver of certain merchant services fee. Cloud growth was better than expected. User growth also came in strong at 62 million in net adds for the quarter. The annual active user growth and order growth were not translated to revenue growth due to promotions. The large number of new users in lower tier regions are dragging down the platform ARPU. Needham lowered its December quarter China commerce revenue by 13% and total revenue by 9%. The firm, however, said it continues to believe Alibaba's well-established ecosystem and strategic position in the e-commerce value chain are competitive barriers to new market entrants. We have another article. It says Alibaba stock is near 3-year lows, why one analyst prefers its competitor. A team of strategists at Swiss bank UBS predict that with the latest regulatory crackdown now outlasting prior episodes, the Chinese tech sector is probably past the worst. They say the market is pricing in a lot of negatives and there may be an overcorrection at hand. They stated, among our e-commerce coverage, we prefer JD over Alibaba as there is more clarity on the long-term margin improvement at JD versus the level of margin decline for the next few years at Alibaba. Well, that's not good news for Alibaba. We are at a very strong support. It hit that support back 2019. If this cannot hold, it's going to get very ugly. I should have hedged my portfolio sooner, but unfortunately, I didn't expect Alibaba to get this low, and I don't think a lot of people expected this. Many people said that 200 was a good buy, 180 was a good buy, 150 was a good buy, and look where we are. We are at 133. We don't know when the bottom is. We don't know when it's going to have a reversal. So what we want to do is try to protect our portfolio. So just buy some insurance. We can buy puts or we can buy some put credit spread. So we'll take a look at the January expiration date. The 100 strike puts are going for, let's see, $200. We have a lot of volume, a lot of open interest. I don't know if these are short puts or long puts, but either way, people are expecting the stock to go to 100. So we want to be able to protect ourselves in this situation. So this is one way to do it, is just buy puts, or you can put debit spread. It is a lot cheaper than just buying straight out puts, but our max profit is limited. So we're going to buy the 105 put and we're going to sell the 100 put, and our cost is $4 and we can make a max profit of $446. So what I'm planning to do sometime this week or sometime next week, whenever there is a bounce, I'm going to buy some of this just in case that there is more downside. So I'm going to spend, let's see, I want to buy at least $1,000 worth, $1,000, and I can look at a max profit of $8,920. That's if Alibaba goes below 100 by January 2021. Who knows what can happen from now until then, but I know for sure I just want to protect whatever I have right now. So that's all I have for you guys. Let me know if you guys are buying the dip, if you're hedging your portfolio as well. And also, I have a Discord Patreon that I'm trying to grow. So if you guys are interested in sharing ideas, come check it out.
About the significant and abrupt deceleration in growth, and as you went through, it's also the competitive losses to JD.com. So those are the big concerns right now. It's really interesting because just a year ago we were talking about the Ant Financial IPO, and Alibaba's stock was over $300, and it looked absolutely built for perfection. And here we are a year later, growth is decelerating, their margins continue to deteriorate. And again, the main concern right now is that they're having competitive losses.
Let's talk about that sharp slowdown that we've been referencing and that the companies have warned about today. What's driving that essentially, or is it a confluence of factors? Is it the fact that we are seeing the Chinese economy slowing as it comes out of its post-pandemic recovery? Is it that there's too much competition now and that they're getting a smaller piece of the e-commerce and retail pie? Is it the regulatory overhang that we've been talking about now for 12 months? Is it China's shift to wanting there to be common prosperity, or is it all of the above?
It is all of the above, but let me try to rank them. It is first and foremost the slowdown in the Chinese consumer. It's been clear in terms of slowdown in GDP, in terms of the slowdown in retail sales, but that we already knew. What was new today was the fact that their competitors are growing faster. That may tie to the other topic you brought up, which is Alibaba has had the crosshairs on their back from Chinese government and Chinese regulators, where a company like JD.com may not have had to deal with that quite as much, and that has impact on brand, it has impact on consumer behavior. So all of these factors are contributing, but overall the deceleration has mostly to do with a weaker Chinese consumer. And as you look forward, that's a concern. If the Chinese consumer focuses on the value of their home, and to the extent that value stops going up or perhaps even starts going down, Chinese consumer is not going to get any stronger anytime soon.